once we looked at the world through this lens of the debasement of fiat currency, which again is still contentious, becoming less so nowadays, but it was really contentious when we started it, we realized there's actually only two assets that outperform this. One is tech stocks, and the other is crypto. And so that completely changed how I allocated and how I understood tech stocks. I was a macro guy. I hated tech stocks. They're always too expensive. You're always a value guy. And I realized none of that made sense in this market.
Raoul Pal's exponential age thesis highlights a paradigm shift where disruptive technologies, exponential adoption, and liquidity dynamics are redefining asset markets. Cryptocurrencies and technology stocks, driven by network effects, are the primary beneficiaries, benefiting from the rapid expansion in the number of users and capital flows. Paul believes there is an expected hierarchy of returns. His thesis is that cryptocurrencies will outperform technology and technology will outperform all other stocks. Cryptocurrencies, as purely digital networks, are experiencing the fastest exponential growth, followed by technology stocks, which leverage software and network effects, and then traditional stocks. As the adoption of a crypto network grows exponentially, the asset's valuation can also increase exponentially, a key pillar of the exponential age investment thesis. Over the past decade, the correlation between the S&P 500 and the Federal Reserve's balance sheet, a proxy for liquidity, has been positive and significant. Markets have tended to rise in line with balance sheet growth. Even more striking is Bitcoin's correlation with global M2, or the central bank's aggregate assets. For example, during the 2018 liquidity crisis, both stocks and Bitcoin experienced significant declines. An empirical analysis by CrossBorder reveals that global liquidity leads markets by 6 to 9 months and the economy by 9 to 12 months. From a multi-asset perspective, high liquidity generally drives risk-on assets, such as equities, especially growth and technology stocks, emerging markets, and cryptocurrencies, while low liquidity pushes investors toward risk-off assets, such as cash, bonds that are safer in the event of falling yields, or sometimes gold. According to Raoul Pal, we may witness the biggest altcoin bubble season. Before we move forward, if you want to stay updated with the latest crypto events and news, you can subscribe to our channel and like this video. Now let's get back to Raoul Pal's view on Solana and the overall crypto market.
If you think the ISM has been low, and then go and ask the average American running an average business in an average town, right? People's earnings haven't gone up. Your mortgages are too high, your car payments are too high, etc. So what happens is when the business cycle picks up, there's more disposable income and businesses have more investment income, and that gets driven out the risk curve always. That is what markets do. That is the game. And altcoins, as Julian said, are no different than junk bonds, no different to all the other stuff. It's all the same trade. So it feels like it's all to come for us. We don't see anything that suggests it's not going to happen. And we talked about before, the size of what's happening with global M2 and the dollar moves and stuff like that are very big. So no reason to expect that the move in asset prices is probably more than people expect. And I think the inverse to the business cycle being so low for so long will be the flip side of this cycle will be longer than people expected. That then extends the business cycle. We don't know yet, but it feels like it's Q2 2024 so far. But if financial conditions keep moving, if they get the dollar below 90, okay, then we're going on further. Maybe it's a full bubble cycle then. Maybe we don't get who knows? But, one step at a time. But it looks good.
Raoul Pal addressed the chaotic market situation, reassuring cryptocurrency investors facing high volatility and explaining why he believes the cycle's expansion is consistent with broader economic indicators. The veteran macroeconomic analyst noted that the sluggish economic cycle, below the key threshold of 50 for the ISM index, a measure of economic activity, is now showing signs of expanding, thereby delaying the peak of the cryptocurrency market. This has likely extended the cycle into 2026, he said, adding that this shift is not yet a firm prediction, but a structural observation based on current data. He links this extension to improving financial conditions, including a weakening US dollar and expected lower interest rates, which he believes will boost risk on assets like Bitcoin and altcoins. He pointed to historical patterns such as the 2017 cycle during Trump's first term, where a similar dollar-driven economic slowdown preceded a surge in cryptocurrencies. Pal's framework, dubbed the "don't blow it" thesis, advises against leverage and overexposure to small altcoins and advocates for a portfolio anchored in majors like Bitcoin, Ethereum, and Solana. He highlighted Solana's oversold relative to global M2 as a buying opportunity and predicted that Bitcoin and Ethereum would outperform until the end of the cycle. Solana is expected to outperform Bitcoin for the remainder of the cycle, as well as Ethereum, with SWI outperforming Solana, refuting rumors of its demise. The collapse of a meme coin. Paul recently shared his analysis, suggesting that Bitcoin dominance may have peaked. This is a crucial indicator that measures Bitcoin's market capitalization relative to the total market capitalization of all cryptocurrencies. A decline in Bitcoin dominance often indicates that altcoins are gaining value faster than Bitcoin or are holding their value better during dips, leading to what is often referred to as an altcoin season. If Paul's analysis of Bitcoin's rising dominance is correct, he believes it could be a sign that the market is entering, or is about to enter, the next phase of this banana zone. This is particularly interesting for investors with a diversified portfolio of altcoins. Altcoins, especially smaller ones, can offer significantly higher percentage returns than Bitcoin during periods of strong growth. An altcoin season often highlights innovative projects and technologies developed on different blockchains. If you're interested in Raoul Pal's analysis, consider your current allocation between Bitcoin and altcoins. The cryptocurrency market is dynamic, with constant capital flows between different assets. Raoul Pal's latest analysis clearly indicates that Bitcoin's dominance, potentially consolidating or slightly declining, could pave the way for the rise of altcoins. Raoul Pal's analysis highlights the importance of macroeconomic factors in the current cryptocurrency landscape. The Business Cycle Index, a proprietary indicator Paul uses to assess economic phases, remains below 50, indicating that the global economy is still in an early recovery phase. This suggests that the cryptocurrency market, often sensitive to broader economic fluctuations, could continue its upward trajectory for an extended period. Historically, Bitcoin's performance in 2017 serves as a benchmark, rising from around $1,044 to over $14,000 in a year. Paul notes that the current market is exhibiting a similar trend, but with potentially more room for improvement. The US dollar index, DXY, has fallen nearly 9% since the beginning of the year, weakening the dollar's purchasing power and strengthening Bitcoin's appeal as a speculative asset and alternative currency. Raoul Pal's analysis offers compelling insights into the cryptocurrency market, highlighting the interplay between macroeconomic indicators and institutional adoption. The weakening US dollar and the ongoing economic recovery suggest that the current crypto cycle could extend into the second quarter of 2026, providing investors with a broader window of opportunity.